Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is a real estate investment expert and my good friend, Feras Moussa. Feras is a tried and true entrepreneur at heart, but with a tech background prior to getting into real estate. He obtained his undergrad from the University of Texas with a computer science degree and then went to work at Microsoft straight after college. And then Feras later resigned from Microsoft to quote unquote bring tech to industries that lack it. And that's where he found his passion for real estate. And shortly after getting into real estate, he built a portfolio of rentals. He completed 9 closings in the first 12 months. So was super busy. And then after seeing the results of his rentals, he decided to move into the bigger and better game of multifamily apartment complexes, which is where he met his partner today, Ben Suttles, and they started Disrupt Equity. And so they are focused 100% today on multifamily syndication. So I'm excited to have my friend here, Feras. Feras, how you doing today?
I'm doing good. Thanks for having me, Kevin.
Yeah,
that intro sounds a lot more formal whenever someone else is doing it for you.
Yeah, that's funny. That's funny. Well, good deal, buddy. We're excited to have you here. As I'd mentioned, we keep in tune here and there, and we probably talk a few times a year. But you guys are always so darn busy. We're just chatting about how busy the end of the year is here as we record this. Shortly after Christmas time, you're recording on December 28th, and you're wrapping up a bunch of closings, both on the buying and selling side. Us doing the same thing, and it's just been a whirlwind of a year, really a whirlwind of the last 2 years, and just excited for what 2022 has to bring. And so, with that, my friend, let's do this. Let's back it up a little bit. And I gave you that brief introduction, but maybe take a few moments, tell our listeners a little bit more about you, your background, and ultimately how you found your way into real estate.
Yeah, absolutely. So for those that don't know me, right, I kind of, like you said, came from Microsoft, was tech, and had a software company after Microsoft, and really was, like a lot of listeners, was looking to learn how to invest in real estate, right? Kind of got that bug, and started with my first purchase, a fourplex down the road from our office, literally about a mile and a half down the road. Got a taste for multifamily, so to speak, right? Small multifamily. And, from that, bought a bunch of houses, because for those that know Houston, there's not a lot of fourplexes, especially in areas that you want to be in. And so, bought houses, realized it doesn't scale very well. And so kind of came across apartments, and the rest is history. And it's just, it's been a lot of fun, right? I love it. And there's always another bigger, harder hill to climb. Right. I think that's ultimately what I like about it.
Yeah. So, add a little bit more context there. Give us time frames as far as, you bought your first real estate investment, bought some single family homes thereafter, and then decided to actually make the shift over. When did that shift occur? How shortly after actually realizing that single families weren't the one?
Yeah. So bought my fourplex, I think 2015. And really within that year, I realized it just doesn't scale very well.
Mm-hmm.
And so about a year later, did my first apartment. It was actually a 99 unit in Atlanta. Right, did a little bit later, and I did that with my partner Ben. And we got into Atlanta. Really, I mean, we're obviously both based in Texas.
Yep.
And at the time, right, Texas was kind of heated. It was really, for those that know, Houston 2016 was the peak. Right now, it's at a new peak, and Dallas has just continued to keep going up and up and up since then, right? And so that's really what brought us to Atlanta. And, we look for cash flow, right? Similar to you guys, we are cash flow investors. So we need to buy, deals in growing markets, right? Job growth, population growth. But on top of that, right, looking for deals that we can buy at a price that makes sense to actually give us that yield that we're all looking for.
Yeah. No,
and
absolutely.
So that's sent us to Atlanta, and, maybe not to go too far down that rabbit hole, but learned a lot on that first deal, right? Bought a deal from someone that pretty much, I like to say, was an accidental landlord, should have never owned an apartment, right? And, and there's a lot of things that apartment that we learned, right? But ultimately, really took a rough deal in a decent area and turned it into a much better deal and built a community around it, right? And so that was a deal that, we brought down to 40% occupancy, then brought back up to 99, and got rid of the drug dealers, the prostitutes, all that. The first, 3-4 months, we brought on security and kind of really revamped that property, and, ultimately had it for a little less than 2 years, and we were able to make a strong exit for our investors.
So you cut your teeth on a fairly challenging one. Sounds like. Let's dissect that a little bit. Buying it in a good part of town, but a kind of a rough complex that you mentioned drug dealers. We got rid of the drug dealers, brought it down to 40% occupancy, which is that's a lot of units, right? And when we're talking about basically a 100 unit complex, I mean, you had 60, roughly 60 vacancies in there. And so let's dissect that deal a little bit. Maybe some of the lessons learned, challenges you faced, how you overcame them, and ultimately what you maybe wouldn't have done again, or what you didn't do again on that second, third, fourth, and fifth deal thereafter.
Yeah, so I mean, the very first thing we learned, really the biggest pain on that deal was actually the lender. I mean, we learned, like I say, I like to say we basically got a PhD in lending. I mean, we've been through all of the things that can go wrong in lending, so now we know a lot more of the key things to look for, right? And as a buyer, a lot of stuff you don't really think about, right, until it's a problem. And so on that deal, it was a bridge loan, right?
Mm-hmm.
And it was really a shop that was kind of known in hindsight for like loan to own. So they know, like you said, you're operating at 40%. I promise you, you're not breaking even at 40% occupancy, right? Break even's closer to 65%. And so you're operating in the red, and they know that, right? On top of that, they're holding on to $1.5 million of rehab dollars. And so you do some work, and they basically give you every excuse under the sun to not fund that work, right? Because the way it works is, we do $200,000 of improvements. We submit requests to them. They get an inspector out, verify we did what we said we did, and then they give us that $200,000 and, on to the next one. And I mean, it was this ridiculous story with these guys because basically they were just giving every excuse, and then we'd come to an agreement, and they say, if you do X, Y, and Z, we'll give you the money, and then we do X, Y, and Z, and a month later we tell them, hey, that's done, and then they come back and they're like, oh, our board didn't approve that deal that we did with you. And I'm like, what the heck? Like, why would you make a deal with us? So, I mean, learned a lot of how challenging a lender can make a deal go. And really every deal since then, we structure them differently. I mean, we're no longer the guys that want to give all the CapEx to the lender. We really focus on just telling the lender we're going to do the bare minimum of what we need to hit the yields and the returns that they want. And really, we're happy to hold on to more capital. And that's really the other big thing that we do differently now, too, is just going in so much more capitalized on really any
Yeah.
deal, right? Whether it's a deep value add or not. I mean, we're sitting on a lot more cash than we have in the past because on that deal, right? I mean, trust me and Ben are the first ones to strike the checks. We literally loaned the deal, I think $200K on that deal just to get it unjammed, right? Got everything done and everybody's home happy. But again, the lender was holding on to $1 million and we needed to get units online. That's how you get out of the red.
Yeah. It's interesting. You mentioned about the lender, they're known in the industry as loan to own. And, I think folks that are getting started, one of the things I don't think they realize so much until you go down the road like you have, or that I have, is that even when working with banks and the commercial side of things, it's actually a negotiation, especially with lenders such as bridge lenders. I mean, it's not, here, guys, this is what it is, and this is all we're willing to offer. There's typically there's some flexibility on both sides of the equation when we're negotiating the actual loan docs, and a lot of times doing the first deal, unless you've got counsel that has gone down that road before, which is the importance of having some really strong counsel that's got expertise in the the niche that you're in, and also has expertise in working with bridge lenders and alternate type of lenders. But there's it's if you can't get exactly what you're looking for, like you mentioned now, like now you keep a lot more of those reserve dollars yourself, right?
Mm-hmm.
If you can't get what you're looking for, move to the next lender, because there's other lenders out there, right? Like don't just put all your eggs in that one basket, because there's a lot of just a lot of crappy lenders. There just are, and they're
Yeah.
challenging to
And
deal
this is,
with, whether they're loan to own strategy or not. There's just some that make life way more challenging than what it necessarily needs to be, especially ones that have multiple layers. There's multiple layers that you have to ultimately go through a board, right? Like, so
yeah.
your
It's just,
counterpart
and the
does.
board is probably two people and they're just making up stuff. It's just,
Yeah, right,
and
maybe, maybe.
that lender literally made that deal at least 3x more challenging than it should have
Yeah,
been, right? Like
yeah,
it really is, and there, like I said, there's a lot of things you can negotiate, right? Even other things like yield triggers, right? Again,
yep.
just to keep yourself safe. Those are things that lenders will give you if you just ask for them, So you learn a lot. It's kind of that part of
So
it.
you took that one down to 40% occupancy. Was that the plan? Was that part of the business plan, or did you also ultimately have like some of a mass exodus once you went in and started
It
changing things
wasn't
up?
really a mass exodus. It was that, whenever we bought it, it was on paper 80% occupied, right? But really, once we got in there, I mean, it was like more like 60, right? And so kind of working through that, and I got to find this picture to send it for you and your viewers. But we, the security company that we had on, they're basically ex-military, and they have this like picture of them all kind of lined up with their weapons, and it was
Oh
just
my
it's a really
gosh.
really good company. And it wasn't, it wasn't like, hey, they're just completely, a pain to the tenants. Is actually, hey, like this place is now protected. Like, there is a curfew and you do need to show IDs if you're here past curfew. Things like that, right? You sniff out all of the kind of the problematic tenants. And it's funny, you get rid of the right 2 or 3 tenants. I mean, it's a whole nother game, right? Like
Yeah.
drug dealers tend to pay their rent. So you have to find another reason to be able to kind of evict that person.
That's pretty funny. Good deal. So you went full cycle on that deal. It turned out well. The buyer, the new buyer that stepped into your shoes. Talk to me about what their interest level was, because you guys had already turned it around. I'm assuming there was probably still a little bit of meat left on that bone, right? Like, what were they looking at? What was their
No,
perspective coming into it?
absolutely right. I think you probably get the question too. Everybody always asks why sell, right? And they say, why is this person selling? And it's usually, right, someone will pay a premium because they can come with fresh capital, right? Because
Yeah.
we ran out of capital. So we either raise more money with our investors to take it to another level or sell it to somebody who will pay a little bit of a premium because they can come in with fresh capital, a new business plan, and push it to another level. So on that deal, we had done, I want to say 10 units that we had upgraded to like a really nice, because whenever we bought it, there was 10 units that were down. And so down to the stud. So we upgraded those, proved, hey, like look at the rents that you can get for this level of upgrade. And so that person came in with the intention of basically doing that for the rest of the units.
How'd
So
you
we,
find? Yeah, go
okay.
ahead. Go ahead. Sorry.
No, I was gonna say, as a seller, right? It's a smart seller is someone that basically sets up the business plan for the next buyer,
Mhm.
right? You want to give them a clear path to what they can do and really help them mold the story. And so that's exactly kind of what we did on that deal.
Good deal. And how'd you find a right property management company to come in and play ball with you, knowing that this thing was going to be a massive turnaround, or did you keep the existing that was there?
No, so definitely not. The other people before us self-manage, and this is where again
Okay.
another pro tip that we learned: you start to learn who you're buying from, right? Like right now, we have a deal that we're closing that's from a sophisticated buyer. They self-manage, but very professional management company, right? Like there's not a lot of skeletons in that deal. Whereas this other deal, the guy self-managed, things were like handwritten. There was a lot of skeletons in that closet, and so for that deal, we used a management company that was referred to us actually, and ultimately very happy with that referral, right? They were willing to work through that deal because again, that deal was a hard deal, right? Even as a management company, it's not the easy deal to go manage,
Yeah.
and so they were kind of working through that with us, right? Occupancy down to 40, dealing with just everything, including being undercapitalized, right? And so ultimately, they worked through that, and we made sure that I got rewarded for that at the end as well.
Is there typically a premium that a property management company coming stepping into the shoes of a more challenged deal like that will get? Maybe on leasing bonuses or just a higher percentage overall as far as, and then it might scale down once it get to stabilized to a stabilized state.
Yeah, any good management company worth their weight, yes,
Okay.
right? It's the if
Yeah.
they know what they're doing, they absolutely should be charging more because it is a
Yeah.
lot more work, right? I
And I'm
mean,
assuming project management fees and things of that nature as well, right? Because they're helping you go through the
yeah,
planning
because I mean, like I said,
process.
we third party manage now too, and again, like a challenging deal is literally 4 or 5x more effort than just a stable deal, and
Absolutely.
so put that in perspective.
Yeah. So let's talk about that. Your property management company. At some point over the last 2.5 years, we were going through it right about the same time that you guys had made that leap of faith and ultimately decided that it was in your best interest to pull it back in the house and go vertically integrated with your property management company, which is, I'd say that's probably that's not the norm, right? You're in the minority of groups your size that are in the
Yeah.
multifamily space, because the typical scenario is basically having the asset management in house, but ultimately handing off the property management to a third party reputable firm. And so, talk to me about the decision to do that.
Yeah. So, I mean, for us, it was an easy decision, right? We were struggling to find good management in Texas. We had different management companies. And on top of that, I think that I saw was just that most of these management companies were built in the 90s and nobody just kind of paused to like modernize these things, right? And I think a lot of it too is that they were used to the owner that's not really on a tight business plan, right? And think the doctor that happens to own the apartment that's checking in every couple of months kind of thing, right? Whereas
Mhm.
right now, right, I like to say we're kind of getting into the golden age of syndication, right? There are more syndicators today than there were yesterday than there were 3 weeks ago, right? And with syndication usually means like there's a business plan, and on top of that, usually tighter margins, right? Like you have to really work these deals and have to actually accomplish what you're projecting versus kind of letting the thing fix itself, right? And so with that, really that means a management company needs to be competent, right, and tracking these things and have data points and actually having a more holistic view. And so for us, we were struggling with management and on some of our Texas properties, and ultimately we knew at some point we were going to have our own management company anyways, right? Because that becomes your secret sauce, and that's we
Mhm.
kind of really grow into it. And we decided to kind of rip that bandit off sooner than later. And timing wise, it worked perfect because 2 months later, COVID happened, right? And so I get nervous thinking about what would have happened had we waited a little bit, right? And because I just cannot imagine how painful it would have been through COVID. Because
Hmm.
really, even with our
By
management
that,
companies, so in
what do you mean
Texas,
by that?
maybe. Oh, sorry. I mean, just would the third party management company actually taking care of the deals and
Mm,
work through it, or just said, hey, no, delinquency's low, COVID, right?
yeah.
And to give you an example, so in Texas, right, we have something called TRR, Texas Rent Relief. That's basically all the COVID money that came from the federal government, administered by Texas. And it was a lot of work to work through that. But I think there was a data point and something like of the first, I forget the exact number of the first $1 million distributed, Disrupt Management, which our management company was like the first 100K. Like we were one of the first ones to get in the line and get that going, get that whole thing moving forward,
Hmm.
right? Which, is awesome, right? And so versus this third party, like I literally know people 9 months later said their management company is still supposedly submitting for TRO and hadn't even gotten anything yet. So
Right, right. When you started that company, what was like the first or second critical hires that you made in order to get that thing up and running? Right. I mean, I
yeah,
know that you and Ben you're involved in the property management side, but you guys are busy as heck on the capital raising and then the asset management side of things. And so who was that critical hire? Was it one or two folks that
Yeah.
you brought
So, and
in?
this kind of leads to your other question. I realized I didn't answer too. Is why do it, right? I mean, management is the worst business in the world. Sorry, no offense to anybody, but
It's not
it's a hard
sexy. It's not
business.
sexy at all. No.
And the sexy side is the buy side, right? That's the fun side of the business. You're striking deals, you're figuring out business plans, and it's the really fun side of the business. But operations are what feeds the other side. And so for us, we brought on someone that had their own management company before, right? Experienced, and willing to basically kind of grind it out, right? She likes to say, it's her last first kiss, right? She's looking for, a good group of people to kind of build that out. And so we knew we needed that person. And then from day one, we treated it like a management company, right? In terms of, we're not here to poor boy it and, we're going to self-manage every little piece of it. It's like, no, let's hire on regionals, let's hire on accounting. Let's
Hmm.
really scale it out. And, one of the mistakes that I think we did early on is that we were using third-party accounting, right?
Okay.
Because we use RealPage as the software that we use, and they have an
Hmm.
in-house accounting department-ish, right? That does it for hundreds of thousands of property. I mean, units, sorry, they do a lot of properties, but we were struggling with them, right? And I really realized that with challenging deals, you need a different kind of accounting on top of that, right? A lot more in depth. And so, we made those investments and brought all that back in house. And now things are humming because really half of property management is accounting. You start to learn, right?
Yep.
So.
Okay. Good deal. Well, that's it. So are there any downsides? We're talking about all the positives of why you went in house and went vertical, right? But any downsides to it?
Oh, there are downsides every single day, right? You hear way
Outside
too
of
much of the
staffing, right?
staffing, and you hear a lot more of the sausage making than maybe you want to hear, right? There's
Yeah.
always drama there, and and I'm, maybe I care way too much, like personally, right, about my brand, reputation, everything, and I don't like for anything to go wrong. You know what I mean? And so it's like with management, there's always things that are going wrong, and it's like I want to go fix everything, right? And you kind of have to step back and distance yourself a little bit, have people that run that business and go do that, and just trust that they're going to do the most important pieces, right, and resolve those.
Yeah. Switching over to the acquisition side of the business, and I know that you're a data guy, and we talked about this a couple weeks ago. We were on the phone about, ultimately how many deals come into your pipeline, how many deals that you actively look at, and then how many that you actively actually write an LOI on, and how the number that you write an LOI on, how many are accepted, right? And
Yeah.
I guess I'm going to take this from a different angle, though. On the acquisition side, we know it's in I feel like I've been saying it's a highly competitive market, especially like where you're buying. It's been that way for years. And I keep year over year, it just keeps getting more and more competitive, right?
Well, it
Like,
was highly competitive. Now it's highly, highly competitive, and next year
yeah,
it's going to be
yeah,
highly, highly, highly
I
competitive.
guess so.
So,
So, it's not how are you finding deals, but I think the more important question is, because there's not a shortage of properties that are being brought to market, right? There's deal flow out there, but the bigger question is how are you identifying the great performers, the great opportunities from the call them turds, right? Like the ones that
yeah.
just that you got inherently bad bones to them, or just or challenged in one way or another. So please, if you
No,
would.
that's a great question, right? I think that's part of what differentiates us, right? We track deals. They're not just like an email that came in and maybe I get to it and maybe someone underwrites it, right? Like we've built out a process, and really one of our big goals, we have really ambitious goals for 2022. But in order to support those goals, we have to have the deal flow and the deal tracking to enable that, right? So we've had a pipeline for a while, and really we have a really awesome one that I'm really excited about that we've been working on, and really, building like a machine, right? Like, think, let's stick to sausage maker, like meat comes in, sausage comes out, right? Like it's that kind of machine where we can source deals, right, and they go in, they all follow the same mold of underwriting, and then from that there is a set of things that we could do that are you know not just data based, right? Because if you do it just data, you'll never hit the right deal, right? Because some of these apartments, there's a lot more you have to understand, so it does need someone more sophisticated. But really, how do you find the kind of that subset that you should start to put some eyes on, and then from that, some of the ones that get deeper dive. And so, for us, there's kind of a couple pieces, right? There is to hit the goals that we have for next year. We need to actually source more deals. Period. Like we know every deal in our markets, but we need more new markets to actually get enough deal flow because historically, right, and we actually ran the numbers for last year, it really was one out of every 100 deals that we underwrote, not 100 deals that we've just seen, but actually went through and had the team do the full underwriting process,
Wow.
or, as our buy. And so knowing that, right, we're trying to basically do 150 deals a month next year. And so we're scaling out into more markets and getting people that are local to those markets, right? And essentially, carrying the Disrupt banner, the Disrupt brand, and really giving that deal flow while at the same time scaling out to where we have a bigger machine that can handle more things coming in.
That's I want folks to realize how much time and energy actually goes into that. So like give me an example of a typical deal that actually is going to go through a full underwrite. Like you're going to have your
Yeah. So
analyst
let's
spend time on how many hours would it take them to actually input the data appropriately and for you guys to run your models on it?
so let's say maybe let me give you for a deal that we bought. There would have probably been. I haven't actually done this number. I would be surprised if it's less than 20 hours, man hours of
Right.
underwriting that, but things that have gone into it because there's multiple phase. There's a time, we have 4 people in the room going through it, because there are different stages to where we start to invest more and more time, right?
Sure, sure.
To the point of like literally we have VAs that call all of the comps around us and understand exactly what concessions and what
Hmm.
things they have going on, right? Which you can't pull that off a CoStar, right? And so, but we don't do that for every deal. So we
Yeah.
really do
I think it's
sharpen that knife as it goes through the
Yeah, and I
process.
think it's more important to know how much time is spent on those 100 that you actually underwrite before you get to the one that you end up
Yeah. So
buying, right?
for
Because
us,
like that's like that's time that you don't get back, but you ultimately have to go through that exercise in order to find that one diamond in the rough.
yes, no, exactly. So for us, I'd say we have pretty much 2.5 people. That's pretty much full-time job. And on top of that, 3 other people that get involved in different parts of the step. And basically, that whole team meets twice a week for an hour and a half each meeting, right? So a lot of energy is going to that and really scaling that out. And maybe the last thing I'll add too is there's always the soft piece of this, which is the story, right? And getting to know the brokers. I mean, we win deals not because we're the only ones to see it, right? But usually we're the first ones to see it, and the broker wants us to buy the deal, right? They're motivated. They know we're easy buyers, easy closers, easy sellers, right? And they bring it to us first, and they come and paint the picture for us, right? Any deal has a story. You have to understand that story and then see if you agree with the story. And
Hmm.
so don't just be the guy that just gets an email and doesn't ask any questions and tries to go underwrite it. You're not going to succeed, right? And so for us, there's a lot of actually energy involved in communicating back with the brokers, right? And we have our little accountability chart of everybody and the roles. And my name is listed. I'm up here. Plus, I'm also the guy that runs the acquisitions for the Texas because I have such a good relationship with a lot of the brokers,
Right.
right?
Right.
They're good friends. They text me. They sent Christmas gifts, all of that, right? And so you have to understand that story along with the underwriting piece of it because they kind of go hand in hand.
So I know that you guys have spent a lot of time in Dallas and Houston, and I think San Antonio as
Hmm.
well, and also Atlanta. And you had mentioned that you need to be able to get your pipeline up to underwriting at least 150 deals a month in order to just basically increase the volume, overall buying volume for next year. What markets are you? What new markets are you bullish on, and and why?
It'll be in your backyard. So Orlando and Tampa
Yeah.
are two of
Mhm.
them. Jacksonville, North Carolina, South Carolina, and then probably a Memphis and an Indy.
Okay.
And so we're bringing on 2 more people that kind of own some of those markets and literally people going out there touring deals, meeting the brokers, and I'm going to be out there actually in
How do
January
you
as well.
find that person that's in those markets that's actually got that uh, they got that local knowledge, that local data? Who is that individual? What is their background? Do you
Man,
find a broker from like a Mark Similichap or CBRE and bring them onto your team, or
it's hard, right? Because you need someone that you can trust because they're carrying your brand, right?
yeah?
And so there's a little bit of like you don't want them to look like an idiot, you know what I mean, and ask things like that. And so it's people that we've got to know through the community, right? And people that are looking to grow, and we like them, they like us, and we're like, hey, let's enable this person, right? Let's let them carry the Disrupt banner, the Disrupt track record.
But
I'm going to go out there.
what's their prior expertise? Like what is their skill set? What are you looking for that individual? I mean, 'cause
Okay,
there's
actually,
there's a heavy load on that person's shoulder,
yeah.
to
So
actually
good
find
question.
deals.
So for us, it's not the analyst piece, right? We have that elsewhere.
Yeah.
And so for us, that person really has been, like I say, needs more of the gift of gab,
Yeah.
right? Someone that is social, someone that communicates, someone that is sharp enough to understand what they're talking through, right? Not just being a sales guy, but really being savvy enough to know what to look for. And hopefully someone that has lived in those markets before, right? That was
Hmm.
really, both the people we have on, they've lived in some of these markets, not all of them, obviously, but have some more of that intrinsic knowledge. And so it's a combination of, you know, having lived there, know enough about the industry, but now they have kind of the rest of the momentum that we have to kind of behind them
Yep.
supporting it. And then ultimately, as we get more deal flow, right, there's other things that we get out of that pipeline outside of just, hey, did the deal work or not, right? It's starting to be able to look at deals in terms of relative to their market. Hey, we saw 75 deals in Orlando. Here's the think of it as almost like a scatter plot, right? Of deals, price per foot, and maybe vintage, and seeing where deals lie. And from
Hmm.
that, you can see which deal was an outlier, for better or for worse, right? And then maybe start to learn more of that market, right? Like, for me, that data is going to be awesome in a year from now, but we got to start to put in that data. And I'm really, one of the big things I'm pushing on everybody to get those reports, where we're looking at them every 2-3 weeks, because what I really would love to do, this is kind of my wish list item, is being able to be smart enough to say, you know what, hey, we we right now, we want to do deals that are 25-30 million dollar races and up, right? So really that means we need to buy something like $80 million of real estate.
Hmm.
But what if we find 2 or 3 deals that are 20 million? I want to be able to package them. But the problem is you need to time it, right? And so what I want to be able to do is basically say, hey, we found a great deal in this market. Let's go find the best. It might not be the best returns deal that exists, but really the best deal in that market today, where we know whenever you kind of average the two together, you actually hit that return that we need.
Yeah.
And then, from that, I can kind of scale out, things like that. And so that's kind
Yeah.
of where my head's at, and how do we start to build that? But I have to have the right building blocks along the way.
Yeah. Absolutely. Any plans for development, ground up development in the future?
We that is one of our goals for next year, is to do one project. And we've looked at, we almost did one 2 years ago. We actually almost did multiple. Something that we both really care about, especially where the market is right now. Pricing is just kind of nuts. So I'd rather find, that one deal that we can kind of go build out. And we're not experts in it, right? We'd bring on people that are the experts, and we kind of partner with them. So we've actually partnered with somebody on a development, which they were the chief. They did, 90% of the
Yep.
lift, but we're looking to kind of do 1 or 2 of those as well. Because I think right now in some of these markets, that's the play.
Good deal. Shifting gears here, Ferris. I know that whenever we go into a deal, if we underwrite it, write an LOI on it, the plan always is to never, if we're going to enter into a contract, it's not to get into that contract and retrade. And I know the business in the multifamily space has changed a great deal over the last couple of years, where I'm guessing that a lot of the deals that you're doing at this present time, you're already doing front-loaded due diligence, because more than likely you're probably putting up hard money day one, right? Is that an accurate statement?
Yeah.
Okay. Okay. So maybe this question is not really relevant, but I'm going to ask it anyway,
Yeah.
because maybe it occurred prior to the shift of where you are today in the multifamily space, where you have to literally, it's kind of backwards, right? You're doing due diligence up front, whereas in a normal sense, in a less competitive type scenario, you would do a little bit of due diligence on the front side as much as possible, but you wouldn't really start spending money and time and energy and resources until you actually had it under contract. And then your money wouldn't go hard until, whatever, 25, 30, 35,
Hmm.
40 days, whatever it might be. That's a little different nowadays. But I'm going to ask anyway. So a deal that you walked away from, you got into contract on it. Again, we don't, when we get into something, we tend to always close, but things can pop up. Has there ever been a deal that you guys have actually gotten, into contract with, that for one reason or another, skeletons popped out that you weren't aware of, that you didn't foresee coming your way, and that ultimately you weren't able to come to terms with the seller and had to move on? Was there anything like that that ever?
Yeah, yeah. So it's funny. So I'll have 2 things to say. First of all, is in a more competitive market, it goes to what I said earlier, which is you're doing due diligence almost on the seller, meaning how likely is this person to have skeletons?
Okay.
Really, that's kind
Yeah.
of how I look at it. And so for certain people, like I said, there was a deal that we chased here minute from our office, huge deal. I actually know the sellers; they're good, genuine guys. I know they use third-party management. Graystar. Graystar is not going to put suspicious things in the financials, right?
Sure.
That deal, I was comfortable putting a lot of money hard day one, right? I knew what I was getting. It's right next to our office, et cetera, et cetera. Newer deal also, right? So it's not like there's going to be a lot of deferred maintenance that's just going to show up out of nowhere, right? versus like the Atlanta thing. Like I should have a lot smarter. A guy self-manages, really doesn't know what they're doing, handwritten stuff. Like there's a lot of skeletons there. I wouldn't go hard on a deal like that. So you're doing due diligence up front, right? And
Good
that's what
point.
gives you the comfort to be able to be more competitive, because the way we can win deals today, pricing is one thing, but it's really terms and certainty of close. And this is where it goes
Yeah.
back to being the person that the broker loves. The brokers go to bat for you, and that makes it a lot easier.
Yeah.
But to answer
No,
your question about the
that's
other part
good.
of it is, we've had one deal we did walk away from, right? And really, it was COVID. I mean, it was, like I said, we've always closed our deal. That was the only deal we never closed. And it was really a situation where the buyer, because, it was right in the midst of COVID. Like COVID happened, we got under contract and COVID happened. And the seller wanted to hold on and refi. And so basically he's like, hey, give you back all your, let's all cancel. If you guys want to back out, nobody knows what the future looks like. Because, rates had fallen at the time. So they were like, hey, I'll just keep it on refi. And so that was a deal that we walked away from. But really, DD, everything was good. It was more about, hey, live to fight another day. I remember making
The
that decision.
uncertainty. Yeah. I
Yeah.
mean, just tons of
So I'd
uncertainty.
rather lose, at the time, we ended up losing more than we expected. That's a long story.
Yeah.
But,
In hindsight, it
we,
would have been a great idea just to close on it, right? But I mean,
yeah.
who knew?
And so we were okay with losing money, and everybody walks away, to fight another day versus going all in. And who knows what happened, right? It was a Corpus Christi deal too, because you had not only what happened with the market, but you also had oil as well. And so I was like,
Yeah.
so.
Yeah.
But
No,
that deal would have been
very
great
uncertain
had we
times.
bought it.
Yeah.
So
Yeah. Well, I guess, again, your industry is a lot different than ours. I mean, very, very few times do we actually deal with sophisticated sellers. Some are more sophisticated than others, but
fair enough. Yeah.
I'd say probably the average deal that we do is probably very akin to the seller that you dealt with in Atlanta. And so
I 100% believe it for
I think
everything you've
that's
told
why
me.
I think that's why I have a lot more gray hairs and probably what I should at this point in my life. But
That's why you're wearing the hat.
yeah, that's why I'm covering up with the hat right now. Exactly. Well, Feras, it's always fun having you, my friend. It's always good catching up with you. I want to ask you one last question, and we're going to wrap it up here. And it's, you've been doing this now for going on 7 years, 7+ years. And you guys have gone literally from doing that, that one fourplex that you bought to doing large deals, incredibly large deals. And so you've scaled very quickly from, again, probably a deal that cost you a few $100,000 to now doing deals that are, north of $50 million. And so going back in the time, you give yourself some advice, knowing what you know today, what would you tell yourself back, 7 years ago when you're getting started?
So what I would tell myself 10 years ago is build your brand sooner, right? Like,
Okay.
that's maybe the first and foremost, right? I was the guy that never did anything on social media. And even today, I'm not that great at it, but I have people around me that help with that, right? That's a big part of it. And then the other thing too is, you have to kind of commit, right? Like getting growth is, people see the roses of it, right? But they don't realize the risk that you take along the way. Like I made a conscious decision with my partner Ben, like, hey, we're going to dump everything we made on these 5 deals back in the company so we can hire on somebody to kind of handle more of the operation so we can continue to buy, right? And we've done that almost twice. Where I was joking with my partner Ben a month ago at our offsite. We're like, hey, this year we're just going to dump another big slug of money back in the company to kind of get the goals that we want for next year.
Yeah.
And so my feedback to people is have a strategy. Don't go in blind, right? Have a goal, but have the strategy to get you there, right? Because, some people say, I want to buy, $100 million of real estate next year. Great. Like, how do you do that, right? How are you going to raise the money? How are you going to source the deals? Does the deal flow make sense? All of the stuff that needs to come together. And so really have a strategy, right? I think people get infatuated with just the big overarching goals, which is good, but back into it and start to decipher and piece it together of how to get there. So.
Yeah, no, I love every bit of it, man. Well, Feras, always a pleasure catching up, bud, and wishing you guys all the best. Again, we're recording this on December 28th. You've already got your goals set in place for 2022, and I hope you guys meet and exceed every single one of them. So,
likewise, thank you very much, Kevin. I appreciate it, and look forward to the new year with you and see kind of where we both go.
Sounds good, my friend. Well, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Butt, wishing you huge success. Take care.